Preparing. What's up, everyone? I hope all is well today. My name is Matt Garland, NMLS number 58700, but I'm better known as MG the Mortgage Guy. So we're back for another great episode, another great conversation. Shout out to everyone who's watching this on YouTube right now. Big shout out to everyone here that's in the Zoom call, ready to go. But before we get started, first, I want to say I hope everyone is out here being safe. Please listen to the medical professionals. Keep plenty of Lysol. Keep your areas corona free. You know what I'm saying? Social distancing is in effect. We need everyone to stay safe, don't be sick, and be healthy, most importantly, all right? So we're going to have a great episode today. We're going to talk a little bit about hard money loans and asset-based loans, right? There's a lot of panic, especially over the last, I would say, week or so with the coronavirus, with everything that's happening in the marketplace today. A lot of people have a lot of uncertainty. They don't know if they're going to buy real estate now. What's going to happen with banks? Are banks going to be lending? You know, what's really going on, right? So today I wanted to do an episode that I don't really speak too much about hard money loans or asset-based. So I figured why not talk to the investors out there today, and let's talk strictly about loans that you can put into your LLC and put for investing. So I'm gonna bring on one of my go-to asset-based lenders, my guy, Kevin. And before I'm bringing him on, I want you guys to make sure, especially if you're on YouTube, make sure you like, comment, share, subscribe to my channel. Make sure you smash that like button. Make sure you guys are checking in on my YouTube channel. Make sure you're watching my Instagram. I'm always posting things on Instagram, keeping people updated in the marketplace. So make sure you guys are really checking in with everything that I have going on. So without further ado, I got my good guy Kevin here. What's going on, Kevin?
Matt, how are you?
Man, I'm alive and blessed. I can't complain. How's everything with you?
That makes two of us. Everything's great. Thank goodness.
Yeah, thank God, man. You staying corona free, brother?
I'm trying. They got me quarantined over here, so I think I'm all right.
Yeah, we got to be quarantine free. We got to be corona free. We got to stay home, social distancing, you know, whatever we got to do to stay healthy right now. What's up with the sound, bro? Whatever we can stay healthy. So, Kevin,
yes.
Before we get started, introduce yourself to my audience. Who are you? Where do you work? How long you been in the business? Give us a little bit of background.
Sure. So my name's Kevin Orlando. I'm the founder of Go Realty Capital Partners, which is a real estate investment banking firm. I structured the firm last year just with we structured the firm as a real estate investment banking platform to give a lot of variety to investors, and there's obviously a need in the market for different types of niches. I started my career out on Wall Street back in 1998, worked for firms such as United Bank of Switzerland, Payne Weber. I've been a capital markets guy for 20 plus years, and I've been lending approximately 16 years now with a focus on asset-based lending.
So 16 years, primarily working with investors only.
Correct. Different types of investors, obviously. Can you hear me?
Sorry. Yeah, not you.
Okay, all right. There's different, obviously within the hard money space or ABL space, asset-based lending space as a whole, there are different tranches of money, right? We have institutional dollars, which, you know, as a mortgage banker, you're familiar with. Mm-hmm. We have, you know, private individuals, truly high net worth individuals who are just looking for a yield on their money. Yield meaning just, you know, the interest rate or whatever they're charging in terms of rate and points. And then you have, other groups like family offices. I represent a few family offices who are essentially wealthy people, and they have what's called a fiduciary, just someone who's responsible for their money, and they allocate that money, diversify it into different investments, and some of that happens to fall within the loan space, and that's primarily the sources of capital for hard money loans and asset-based lending.
Okay, all right. So I'm gonna ask you a few questions here, but let's start this off with the ABCs. For the beginners out here who really do not understand asset-based or hard money financing,
Sure.
let's start off with hard money loans. What is a hard money loan?
A hard money loan is a loan that's used, usually a short-term loan, 12 to 24 months in terms of time frame. And what we are doing is we're primarily looking at the asset itself as we're underwriting the asset. So we're looking at the asset. Not that we don't look at the individual and credit, we do, but the asset has to make sense. Do you want me to give you an example of what that might be, Matt?
Yeah, absolutely, please.
Okay, so let's say, and I'm going to use very simplistic terms. Let's say we were buying, you had a property that was worth $100. Again, we're going to be extremely, simple here just to break it down. And you were able to purchase that property at $70,000. We would essentially bridge the difference between, and again, there are numerous factors there, right? So some people might be able to go to you to get that done if there was enough time. So there's also a time factor. Like someone needs to get something done quickly. That's where hard money comes into place. That's one of the reasons.
Okay.
But essentially, we would give you 70 cents on that dollar. We would lend 70% of the value of that asset itself. Depending on, and again, I want to keep it basic, depending on what you're doing with that asset. If you're purchasing it to hold for cash flow purposes, or if you intend on buying it and renovating it, there are obviously different loan to values as what's known in the business. And, but primarily, again, hard money is short-term loans, 12 to 24 months in nature. People always ask what the interest rates are. About 3 days ago, I would have told you anywhere between like 8 and 12%, or 7.5% to 12%. But as you know, there's been a dislocation in the market, and the secondary is really acting up. But typically, let's again just go back to pre-corona numbers. I would say the interest is anywhere between 8 and 12%, with 1 to 3 points per transaction. So,
all right. So hard money lender typically will lend 70%. And when you say 70 cents on a dollar, you're talking about the ARV, correct?
I was strictly talking about an as-is deal. That's what I was talking about. If we're going to talk about a fix and flip, I would ask for 2 valuations personally. I like to know what the asset's worth today. So like in an appraisal, I would ask for the as-is value of the property. And I would also ask for the after repair value of the property. I would lend 70% of that after repair value. So let's say that property that was worth $100,000 or $100, you were able to pick it up for $70. But if you put $30,000 into it, it was worth $150. That deal would make sense, because if you had if I gave you 70% of that $150, it would leave us with $105. Right.
Okay.
So that would be a gross loan. That's what's known as the gross loan. And if you back out the $30,000 of renovation from the 105, it leaves us at $75,000. So what we look at is we want to make sure that that purchase price and that renovation budget fit within that gross loan. So again, if we were going to use a 70% ARV on the $150 property, it would work out to $105. So that would be a home run deal. That's an example of a really good deal.
So that's how you basically, and I want people on YouTube, if you're in the webinar, to understand like these calculations, right? Typically, these numbers you're given are for more experienced investors, or are these figures you're given for a first-time investor?
Great question. Typically, we like to see experience. It does not mean that you cannot do a loan. Does not mean that you cannot get financed by a hard money lender or someone focused on fix and flip. You can. The ARV or the LTV based off of the ARV might be lowered a tad, maybe by 5%. So maybe you're getting 65% of ARV, maybe 60% of ARV. And total dollars, again, there are two components that we want to look at. Obviously, ARV is one of them, because again, that, and I don't want to lose people here, but you have that gross loan of $105,000. You also have that $70,000 purchase price, right? Like that's a real thing. So you have to have skin in the game. So you're going to bring money in based off of that $70,000 purchase number. Now, depending on the pedigree, the experience of the borrower, that's going to determine how much money we want on that purchase price. So someone who's never done a deal, I always tell them, listen, be prepared for 20-25% of that $70 number. You know, you have to have that available, because again, you have to, there are two components that you have to look at. You have to look at the after repair value, and then what are you given on the purchase price? Because no one's going to give you 100% financing. That's just, it's not going to happen. Whether it's a first timer, I know that there are groups that speak about doing 100% financing. I know they underwrite more like a bank, and that's not what asset-based lending is in my eyes, but to each their own. So again, if we were buying that property for $70, and I said, listen, just have, I don't know, 30% of that available, so you'd have to bring $21 to the table, and that would leave us with you'd have to bring $49 essentially.
So basically, make a long story short, if a first-time investor who's going to watch this video right now, and if they're looking to do a fix and flip, right now, they'll probably, if the house is $100K that they're buying a house for, they can anticipate that they'll have to put a down payment of at least 30%.
I would believe, yes. We have to look at that purchase price number. Yes, absolutely.
So the down payment is based on the purchase price, not the full amount. So let's just say in this situation they needed $50K of rehab. So right. Are they putting 30% on the 100, or are they putting 30% on the 150?
No, they're putting 30%. Great question, by the way, Matt. They're putting 30% on the 100. That's it. Yeah, so that 150 is a number that lets us know that the profit margins are there within the deal. Okay. That's really what it comes down to. Because again, if they're paying 100 and forgive me, sorry about that.
No, you're good. You're good.
If the property's worth $150,000 upon completion, and we're giving you 70% of that after repair value, you're at $105,000. Your purchase price is $70,000. I used a $30,000 renovation budget before, right? So that would 70 plus the 30 would leave us at 100 grand. You actually have room in there. So again, for us, that would be a great deal, because when you sold that property, the margins are 35%, 35%, which is a great deal.
Which is a great deal for any investor.
Absolutely. So I think that's one thing a lot of people have to look at too, Matt, that they don't. They have to look at profit margin. Profit margin from the ARV is very important, because again, asset-based lending is based off of the asset itself. And one of the most important things that I want to see, maybe some other hard money lenders don't want to see, I want to see you get out of the loan. That's the most important part, because
is your exit.
yeah, absolutely. People say that you make money on the entrance. Some people will say you make money on the exit. Quite frankly, it's on both.
Correct.
Yeah. So I want to make sure you get out of that loan. So I'm going to underwrite it with not only the fact that, hey, we can make this much in terms of interest and fees. No, I want to know that you're able to get out of that loan. And if you're not able to get out of that loan, or the deal is not viable from a profitability standpoint for the borrower, I will not finance that deal.
Okay. So look, for all the new people, AR, because I know we're throwing a lot of acronyms out here. ARV.
I'm sorry about that.
Is,
yeah.
No, it's all good, brother. It's all good. ARV is your after renovated value. It's basically, long story short, it's the comps. What are the homes selling for in the area after you do whatever rehab you want to do to the home that you're buying? All right. So it's very important for all investors, first time, seasoned investor, that the comps in the neighborhood where you're looking to purchase that property, because that's going to ultimately determine how much financing that you can get on your project. Now, when you say experience, right?
Mm-hmm.
If someone owns, let's just say they own, a four family right now, and
Okay.
they live in the house, but they have a history of collecting rental income.
Okay.
Does that count as experience?
It's an owner-occupied piece of property. So from a structuring standpoint, let's say if you did an FHA loan for someone, Matt, right?
Mm-hmm.
And they did it 12 months ago. And maybe they had a conversation with Sabine and they moved that property, and they moved that property to an LLC.
Okay.
The reality is that, let's say they left the property, I don't know. That means they have a deal under their belt, essentially. I would say that's a deal under their belt. I would also, what I would do if there was any renovation done in the property, I don't care if you just painted, I don't care if you sheetrock, I don't care what you did, I would keep an account of that to know. So you might go family thinking that, there's nothing that needs to be done, but maybe you change windows, maybe you wind up painting, and all that stuff costs you 25, 30 grand. Well, guess what? You just did a renovation. You did a
Mm-hmm.
renovation on a piece that you were occupying, but maybe you're on to the next step, which you preach house hacking in a very, very, I love the strategy. It's a great strategy. And if they were actually executing that strategy and going on to buy another piece, yes, that four family is track record. I would use that.
So you will use it. So typically,
Yes.
how much experience or how many deals do you need to see under someone's belt before they can get better financing terms?
So, like I said earlier in the conversation, we're structured as a real estate investment banking platform. So we don't only offer, bridge financing, 12 to 24-month money or hard money. We also offer long-term paper, 30-year loans for investors. I just closed a transaction for a borrower who it was their first deal. They had to bring 20% to the table. The property cash flow, the credit was fantastic. I knew there was no pedigree, which was okay, because the debt service coverage ratio, and I'll explain that in a very simple manner in a moment. It was like 1.25, 1.3. So
Okay.
it was good. So for everyone out there, basically what that means, debt service coverage ratio is just another acronym used in the business. But let's break it down this way. If you are making $1,000 a month, your expenses are only $700. That's a good way. You're essentially putting $300 in your pocket.
Okay.
It's a reverse way of looking at debt service coverage ratio. If you wanted to be, fancy and do it another way, we could. But essentially, if you're bringing in $1,000 and your expenses don't exceed 700, that's a good deal, believe it or not. Now, if you did that off of 4 units, that's 1,200 net. So, again, we can do deals like that.
All right, so let's not go into DSCRs.
Yeah,
right.
let's not. I don't want. Yeah,
I want to save that for later because because people are always talking about the fix and flip. Everybody wants to fix and flip, so I kind of want to go that one first.
Sure.
So with the fix and flip or the hard money buyer, for the new investor, there's a lot of people out there that will say, well, I can give you 75 LTV on acquisition or 80 LTV with 100% rehab.
Right
Would
now,
you
right.
recommend those type of that high financing to anyone?
I mean, quite frankly, I would say it's deal specific. I really
Okay.
would. If you had a home run and there was enough, room in the deal and you could make good money, then I think you should do what you have to do. I guess I would ask you in return, are you saying that the 20 or 25% is too much to come up with, or
No, what I'm saying is like, so I there's always like ads going around on Facebook,
right?
YouTube, wherever, where guys will say,
Right.
well, we can finance up to 80% LTV. LTV is loan to value, guys.
Right.
So up to 80% of the purchase price and 100% rehab, which basically means you're only really left with a 20% cushion
Correct.
on that deal. So for me, I always try to advise people don't go that route because it's too high. And what if, because like you said in the beginning of this, we got to think about the exit also. When you look to
Right.
refinance, if you can't sell and then now your flip flops and it turns to a rental, now you don't have enough room in your deal to kind of refinance out of it.
That is a very good statement. And that is exactly why I look at deals from a two-prong approach. If
Okay.
you remember, we spoke about the 70% after repair value.
Correct.
And then we spoke about how much on purchase. So what you're referring to is someone coming in with 20% on purchase. That's when you see like an 80/100, they would give you 80%. It would be 80% LTV off of the purchase. But they would also, the loan is based off of the after repair value. So
Okay.
it's two prongs. It's a two-prong approach. People have to look at it from two sides. You have the ARV, which has to make sense. If we go back to the first example that we used, $150,000 house, 70% ARV, 70% ARV is 105,000.
Correct.
That would be the gross loan. Okay. Now, if this individual was buying the property for $70,000,
they'll have 35K for rehab.
They would have 35K for rehab.
Okay.
Now let's look at the fact that they'd have to bring 20% of that in. So 14 minus the 70, where does that leave us? $56,000 in terms of what they would have to bring to the table.
Okay.
Okay. So they would have to bring $56,000 to close that transaction. Now you have the spread of $150,000 minus $56,000. Now, sure, you're invested 20%. That's skin in the game. That's fine. But essentially, what you're looking at here is just under $100,000 in profit, minus your 20%.
Minus your 20%. So in a situation like that, it's very important that an investor, especially a first-time investor, negotiate. So that way they have a little bit more room for rehab.
Absolutely. That purchase and rehab component is something that I stress to the people that I deal with, even the seasoned guys. They think they can kind of go outside that realm because they know, they know the market, but no one really knows the market, Matt, right? I mean, again, we were having a conversation a few days ago that was totally different.
Great.
Yeah, everything was fantastic.
It was fantastic just 3 days ago.
Yeah, it was all good just a week ago. But here we are. And things have changed literally overnight, and things are changing literally hour by hour. I've been on the phone since last night from 10:30. I was on the phone With California, there's just so much going on in the secondary market. But bottom line is that there are still deals out there, and there are deals to be done. It's a great time to invest in real estate. Now, people might say, oh, of course, you guys are going to say that. You guys are real estate investors. But let's think of every time throughout history, and I'm not a politician. I don't want to get too off. I'm not that. But the safest asset in the world has always been its real estate. That is the flight to safety. So with everything going on, real estate is still a great investment.
Absolutely. I mean, look, real estate is a long-term game, but obviously everyone wants to make money right now, and flipping homes is the quick way to make cash capital and make earned income. So just to recap, investors should be looking at the ARV, timesing that by 70%. So that way they know what the total loan amount they can get financing for, kind of working their way backwards versus starting with purchase price, then rehab, and then trying to figure out financing, basically.
Beautiful. Well said, Matt. I would say the two things that they need to look at, it's three things. You're right. Start with that after repair value. Number one, what are the comps in the area so you can get an idea? The purchase price would, be another great indicator of where you need to be. And then what really makes or breaks the deal sometimes, it's either or. It's either the purchase price is too high or the renovation budget is too high. But if you find that sweet spot right in the middle, you have a kill. But ARV is what you're looking for, first and foremost.
Now, a lot of questions that I always get is, who's backing these loans? Like, is it government backed? Is it privately backed? Like, who's securing these loans? Like,
great question.
Right now, you and people probably, I want to talk about this a little bit, because you just said that you was on the phone with California. There's secondary issues. There's like liquidity issues right now in the marketplace.
Absolutely.
So like, who's backing these loans? So that way people have a better understanding of the back end of what you do.
Great question. So there's what's called a secondary market.
What's the secondary market?
The secondary market are basically institutions that buy mortgages. Just like you have Fannie and you have Jenny, you have a secondary with hedge funds, alternative investment funds, and they buy these types of loans. So you have different ways of structuring these deals. You can obviously sell the paper off right away. There are people that do that. They write a loan, they sell it off. Some people, we participate in most of the loans we do.
What does participate mean?
We invest our own money. So when I give you a loan, I believe in what you're doing. I want to make sure, I like to meet you. I like to see the property. I like to kick the tires, know what's going on. I like to know the truth. And because I'm putting my own money out there, that's, so that's another way. And then obviously there's private individuals. So that's where, in the beginning of the conversation, I talked about family offices. I talked about high net worth individuals. There are people out there, and this might seem, for some people, it's not far-fetched. There are a lot of people sitting on cash and they don't know what to do with it. And one safe alternative are loans, because they just want to make, a certain amount of interest off of the money that they have. So I have structured with numerous individuals upwards of $80 million to write loans for these individuals and participate alongside them. And again, that's me investing with them. So as co-investors, essentially. So you do have a secondary market. And again, that secondary is where institutions are buying that paper. And that's where you're seeing a bit of a roadblock right now, because of all the liquidity issues. It's all a trickle-down effect. People don't think that Goldman Sachs invests in the fix and flip space because you never see Goldman Sachs talk about it. They don't think Wells Fargo participates They don't think Bank of America participates, but at the end of the day, they do, because they own subsidiaries that buy hard money loans, fix and flip loans. So, yeah, that's something that, that's a great question. I'm glad you asked about the secondary, Matt, because it's a very real thing. And yeah.
So it's secondary marketing right now, right? So we have, look, it's panic right now in the marketplace. Everyone's scared. It's fear all over the place. People are saying, well, I'm gonna wait until this, I'm gonna wait until that.
Right.
Now, from a lending perspective, from a hard money or asset-based lending perspective, do you think there's going to be an issue with funding deals right now because of what we're seeing happening with the market today?
Great question. For some people, yes. Yes, I believe that some of the 30-year paper that you've been seeing, like 30-year investor loans, I think you're going to see some of that tighten up.
Okay.
That's already happening, just so you know. From the short-term fix and flip loans, I think things will be a little more stringent from the institutional side. Maybe credit scores might be higher. I think you're going to see institutions being a little more selective.
Meaning on the back end, when they buy loans from guys like you, instead of requiring a 600 or 620 score, they're going to tighten that up and say, you know what, we want to see a 680 score now.
Correct.
And if you want this higher loan to value, then you may need to have, X, Y, and Z amount of experience over the last 12 months for you to achieve that goal, versus right now where it's kind of still, or let's talk pre-corona, it was kind of like, okay, you're an investor, you have some money, great, here's your cash, and go ahead and knock yourself out, basically, right?
I mean, yeah, that's exactly what we were dealing with, Matt, but that really has changed in the last 48, 72 hours. So you're going to see a lot of constriction. You're going to see people that are more conservative. Again, that's 7% money, 8% money. You're going to see the margins go up. Interest rates, although interest rates are, you put up a great meme the other day, that rates are so low and people are expecting that pass through.
Yeah.
But at the end of the day, from the banking standpoint, that's just, and the market reacting the way it is, there's a profit that, banks loan money and institutions loan money for profit. And, just because things are low in terms of rates doesn't mean it's passed through. So I think you're going to see an increase in pricing. I do believe that. And I strongly believe that you're going to start to see, high single digit and low double digit interest rates.
For investors.
Yes.
For investors with hard money.
Yes, correct.
All right. So hard money in this new recession that we're about to go in could get a little bit more expensive.
Yes.
Compared to conventional financing right now. So it can go into that 10, like you said earlier, pre-corona, 7.5% to 12% was kind of like the range. But now, after corona, we're probably going to see more in that 10 to 15% range.
We're going back to the old days. I see that happening because, as you know, you've been in the business a long time, and hard money was never this cheap. This is
very cheap. One of the first hard money deals I ever did in my life was like 16%.
Don't feel so bad. We closed. I never forget. One of the largest deals we closed was a very nice deal. Off of it was in Jamaica. It was near Jamaica Estates. 52 unit condo development. We were all in. With some brokers, et cetera, Matt, 24% for a ground up construction deal. And we're going back to 05, 06.
Yeah, that's around the time it was like when I got like 16%.
Yeah.
So hard money, To put a button on a hard money topic real quick, it's still available out there for
Yes.
investors who want to fix and flip. It's not shutting down, correct?
It won't shut down. And I can only speak from my perspective. What I've been doing is, again, co-investing and investing in deals that I really like, investors that I've been doing deals with for quite some time. I've been putting my money into deals, and we have a lot of dry powder available. What the hell is dry powder to everyone? It's cash.
Okay.
We're sitting on cash.
Dry powder equals cash.
Yes, dry powder equals cash, which right now is king. Because again, if the credit markets are constricted, and rates are so, what does, if rates are so low and you can't get the money, what are we really talking about?
Yeah. Agreed. So with hard money is still going.
Yes.
Do you think it's a good time, just from your experience, and you've seen deals and underwriting deals for 16 years, you've been through the Great Recession,
Sure.
you've come out of the Great Recession. Do you think right now is a good time for people to do fix and flip projects?
That's a great question. I think the margins need to be right. If you're not taking the margins into account, meaning profit margin, I'm being candid, I would steer clear. I would, because again, people have to remember, we don't know what's going to happen within the next 90 days. We don't know what's going to happen within the next 180 days. If you do a loan, you have to consider the carrying cost of the loan. What's the carrying cost? Your monthly payment. Some areas, taxes are not, in the boroughs where $6,000. Go to Jersey, they're $14,000. Long Island,
Correct.
that's another $1,000, $1,200 on top of your payment. You have to be ready to take on some of those costs, and then obviously get out of the asset. So I think that, again, it's a deal by deal basis. I shouldn't have said don't do it. I say it's a deal, and it's got to be a great deal. I'm sorry.
So proceed with, so right now, if you are a fix and flipper, you need to proceed with caution.
Yes, proceed with caution. Make sure your deals have enough juice in them. Don't try to play the game tight where you think, oh, I have a 20% margin, I'm good. No, look for those larger profit margins. And if it means passing on a deal, then pass on a deal. There'll be plenty of more deals coming up. 100%. I am seeing asset managers, people that manage the loans that we were just talking about in the secondary, trying to sell some paper off at a discount. So that
what's an asset manager?
Okay, an asset manager is one. Okay, so the secondary that we discussed a few moments ago, there are individuals that manage the loan pools that other lenders sell to them. So someone buys $10 million worth of hard money loans at 65% ARV or 70% ARV. And maybe, one of their investors who gave them a line of credit or whatever it may be, they say, hey, look, no, not right now. We're going to wait and see what's happening. Those asset managers have to do something. So some of them are selling a portion of those loans off of what's called the balance sheet, which is basically how many loans and the dollar amount of those loans, what they equate to. So you're going to see some of that happening. My point is, you're going to see good deals. So, I wouldn't be, proceed with caution and don't be married. But isn't that always the rule, Matt?
I think people have been spoiled over the last 5 to 7 years.
Yes.
In the real estate investing space, I think with home prices steadily appreciating, money becoming cheaper and cheaper as the years went on. And there's been peaks and valleys with interest rates, things of that nature during this time. But there hasn't really been a true correction in home prices and home values over the last probably, 5 to 7 years easy.
Right.
So I
Right.
think a lot of people are just spoiled to seeing wins, right? And seeing good margins on their deals. But I don't think people were really proceeding with too much caution because it was just too easy. It's like, you trying to, shoot a basketball into a pool, right?
Right.
It's like it's very hard to miss
Right.
if you are buying in certain areas. Now, I'm not saying that people didn't take losses. I'm not saying people made bad deals because I've seen terrible deals over that time frame too, but more
Absolutely.
wins than losses,
Right.
at the end of the day. So, and that's why I wanted to have this conversation with you because people still want to invest. People are nervous about investing, but I think people need to really understand the financing and to really be a sound investor. You know,
Yes.
people, if you understand the math, then it makes it a lot easier to make better business decisions versus emotional ones. And because if the numbers don't make sense, then the numbers just don't make sense. If you can't
Right.
get approved, then
Right.
you can't do the deal. Unless you got it all, 100% cash in your bank account. You know what I'm saying?
Sure. Sure. You can't
So
fall in love with deals. That's the
you can't
bottom
fall
line.
in love with deals. You can't fall in
That's
love with no deal. You
rule
can't be
rule number
emotional.
one.
Rule number one: don't be emotional.
Right.
Um, but I agree with your assessment. I think right now, depending on the market and depending on acquisition price, fixing and flipping could take a huge decline
It can.
over the rest of this year because of the coronavirus, in all honesty.
I think the tri-state area, especially, we're seeing a lot of things happening within the tri-state that a lot of, again, it's not really being discussed, but um,
There's a
that's,
lot of foreclosures. Let's talk about that real quick because
oh yeah.
people don't really understand um, the foreclosure that happens in the fix and flip world.
Okay.
People automatically think, and obviously social media brings a lot more attention to real estate investing, and people really only show their wins, they don't show their losses. But talk about the foreclosures, like how many, just because we're local here in New York. So talk about just from our market, like how many foreclosures have you seen over the last couple years in the fix and flip space?
Um, my portfolio, the loan, I can speak for my loans. I haven't had any defaults.
That's
That's
perfect.
that's the goal, right? That's my goal. Um, have I seen any defaults? Absolutely. I've seen deals that have gone bust. People didn't plan properly from a renovation budget standpoint. Maybe they thought they were going to get plans and approvals and permits, and that took too long, and the lender was just not really willing to capitulate or give people, I won't say ample time, because when you have a conversation with a business conversation, and you tell someone across the table from you, hey, look, I need this much money, but I'm going to have it back to you in 12 months, then you should be a person of your word and have that money back in 12 months. And if you don't, well, here's what it is. I mean, that's what you essentially agree to. And yeah, I've seen that happen. um, I also see, yeah, I have seen it, Matt. I've seen it.
So let's transition off of the fix and flip stuff, and let's get into rental properties.
Okay.
Right now, I'm always a big fan of rentals. Um, I
Likewise.
like I like long term
Hmm.
versus short term gains.
Sure.
I think that's just a better way to invest, in my opinion. You buy for cash flow, not for equity. I'm a big fan of that. Now, what type of products are out there for investors who don't want to go the conventional route and
Hmm.
provide, like if someone comes to me and they want to do a Fannie Mae investment loan, I need W-2s, pay stubs, tax returns, letters of explanations, your blood type, your firstborn, your left shoe that you currently have on. But
Oh, that's great.
what if we have guys out here and women out here that don't want to go to Fannie Mae and come to me, but they want to come to you? What type of products do you have for that real estate investor that just wants to focus on building a rental portfolio?
It's available. It's definitely available. Um,
Are you seeing any liquidity issues with that type of product?
Yes. Yes. I know of 4 institutions over the last 24 hours who have halted purchasing 30-year paper.
Wow.
Yeah. And there are those that are still going to be in the space because they were wise with their underwriting guidelines. And again, there's still opportunity for investors that are looking for long-term paper. Yeah, no, it's there. It's definitely there. But again, we have to go back to one of the things that you just said. You buy real estate for cash flow. You don't necessarily buy for equity. So what I would want to see a property that cash flows and cash flows well in the event that, all hell, everything, look at the situation we're in now, that the property would cash flow on its own, where you wouldn't have to go into your pocket, dip into your pocket. We just want to know that the property stands on its own, with or without you, with or without your job, so yes.
What kind of documentation do you require for these types of loans?
What I like to see typically are, let's say are we talking about a purchase or a refinance, or do you want to go into both?
Let's go into both.
Okay. So on the purchase side, typically 80% LTV is what you'll see, or 80% of the purchase, I should say. Let me rephrase that. 80% of the purchase. So okay. 20% down. I'd like to see leases, or at least, and again, if you're purchasing, you can't have a lease, right? But you can have leases that are subject to. That kind of works.
What does subject to mean?
Subject to, great question. Upon purchasing the property, that these leases will become effective. That you essentially have tenants lined up.
Okay.
To occupy the property. Now you might buy a property that already has tenants. If you do, fantastic. You can present those. But if we're buying something that has, no occupants, then you would do something, again, subject to. Once the transaction closes, you have Tom, Dick, and Harry who are willing to move into the property. Documentation wise, typically, again, some of the things that you ask for, we ask for. So, borrower ID, these are obviously set up within an LLC. We don't write paper to individual investors. So we'd want to see formation documents of that LLC.
Can it be a brand new LLC? Can I just
absolutely
open the LLC tomorrow?
Yes.
And get financing?
Yes, you could open the LLC yesterday, have your SS4, which is essentially your EIN number from the IRS. Mm-hmm. You would have what's called an operating agreement, which basically outlines the ownership of the entity. So let's say if you're buying the property with a partner, it'll be 50-50 on the operating agreement. If it's just one individual, then that person owns 100%. And they would be 100% owner on that operating agreement. And that's pretty much what we would ask for from the LLC side. In terms of liquidity, I would say we want to see a few months, 4 to 6 months of pity available, just in the event something were to go awry. So a bank statement. I mean, it could be a bank statement that you produce, you got yesterday, and it just shows that you have the capability of paying the loan for 4 to 6 months.
So hold on, we're talking bank statements and cash, right? Can
Correct.
I use mattress money? Can I use, like, do I have to source where I'm getting the money from?
I I had an interesting deal in Yonkers a few weeks ago, and gentleman was a bodega owner, and he was very creative, did things by the book, but essentially he was able to bring money to the table, checks, etc., that he was able to close. Was he primarily a cash guy? yes. But at some point, yeah, you have to show cash.
Okay.
You know, I think that's just, I don't want to give people the false impression of come to the table with, you know, $50,000 and you're good. As you know, any transaction now within anything above $300,000 is pretty much, you know, it's the feds, they know about it. Federal they just know about it. So you again, you want to kind of be.
So you have to like do some
that.
as a lender when you do a deal over 300,000, you have to pretty much report the transaction.
Well, title will report the transaction.
Title has to report the transaction.
Yeah, absolutely.
So basically, if you a
there's
dope
no like
boy,
cash deals anymore. Like you know, the knock at the door with your like I have $800,000 to buy your house with a bag of cash.
Nah.
Yeah.
So basically, if you're doing illegal activities, then it might not be wise for you to even although you're using LLC, you know, it might not be wise for you to kind of just dump that type of cash into a deal right away.
No, I mean, look, and again, let's not even talk about, you know, dirty. Let's just talk about, let's say if you're a person that, you know, maybe you're a personal trainer, you know, and you were making, you know, $2,000 a week, you know, start depositing that money. That's all. I mean, what's wrong with that? You made a living. You're putting the money into the account. At some point, you will pay capital gains. You will pay taxes on it. What's wrong with that? There's nothing wrong with that, if you ask me.
Agreed.
You know, so you can. You just have to be ready to bite the bullet. If you're totally against paying Uncle Sam, and I think everyone is, but it's just, it comes with the territory. So, you know, yeah. But this gentleman actually put, you know, he was willing to put $40,000 into an account, and he did it with no issues, and we closed.
And you closed with no problem. Okay.
Yeah.
So with the asset base, so when you're doing a rental property, are you able to go over 4 units, or you have to stay within that, you know, 1 to 4?
No, I can go over 4 units. I can go up to, again, I can play the multifamily game all day long, you know, so my dollar amounts rev up to, I would say, comfortably $40 million.
Okay. What's your minimum?
A lot of people ask that question, and there's as much work in $100,000 deal as there is in a $30 million deal right now. So, but I like to, there's something about executing, man, that I just love, you know, and I feel like the lower spectrum, like the 150, 200, 250, like a lot of people don't want to touch that stuff. But, you know, I have good staff and I lean on them, and I feel like we're helping people. So, like, why not give them an opportunity? So I don't really let that stuff go.
So what about the person who wants to buy something in Cleveland or Memphis, or, you know what I'm saying, like one of these states where you can still get a multi for like 60,000?
You see that, you know, when you're dealing, okay, so when it comes to out-of-state investing, what I like to do is lean on a portion of institutional money too, because it's just, you share the risk. I'm not in Memphis. I'm not in Cleveland. I don't go to Cleveland. I don't go to Memphis. So we would like to see a dollar amount above, I'd say, 80, well, the $100,000 mark would be nice. You know, that's fine. But an opportunity is an opportunity. If somebody's, you know, getting a great deal and it's cash flowing, I mean, why would I turn that person down? It's really just a matter of processing and paperwork. And again, I'm staffed enough to make that happen for someone. So
let me make sure I got the record clear right here. You will do a deal under 100K.
I will do a deal under 100K. Let's not get too far under 100K, like that 50, 60, 40, 26. Like I get the calls for that stuff. And I wish I could be more helpful, but from an economic standpoint, it doesn't make sense. So again, I'd say let's try to stay above that $100,000 range. If there's a $10,000 differential, or 90 grand, 80 grand, 85, I would do it. I would do it. I would do
Okay.
it.
I mean, it's
Yeah.
good to know that'll be done, because one of the biggest, pains that I run into is that not on the conventional side, because Fannie Mae would do 50K with no problem. When
That's awesome.
it gets into high cost,
Right.
because of the regulation on our end, so it
Right.
gets a little tricky sometimes because of the fees, but it can get done. But for the true investor that wants to be straight LLC, a lot of people out there don't want to touch that paper. Even I'm starting to see now the 100K and the
Mhm.
150K is becoming like a real pain,
Right.
to get financing. A lot of people are just pulling back from that type of those type of deals, those smaller type of deals. So it's good to know that the audience and we all have a resource in you, that if we have a good deal and it makes sense, that you're willing to help fund that deal.
Absolutely. And that's why I think it's very important to have regional, you have to have partnerships with regional folks. I think that's very important. I might not like to land bank. You might not like to land bank, right? But if we went to Texas,
What's land bank? Explain
land
that.
banking is somebody who buys land and they love buying land and they think it's the best thing ever. And, it's in certain parts of the country, and you've done seminars throughout the country. Um, Land banking is basically buying land and holding it. And
Okay.
it's a great thought process, because you're not making any more, there's not any more land being created. But land banking in certain areas is definitely more profitable. It goes by geography, essentially. The point I was trying to make is that you and I might be very comfortable doing a multifamily deal in New York, New Jersey, Connecticut. This is our market. If you ask somebody from Texas to do a deal in New York, they would, a deal like that, and it's not even a complicated deal, they might not be interested in doing it, because it's a different animal.
Yeah.
So yeah, what I was getting at is regional partners that understand, the specific assets that you're underwriting, co-investing in. It's important that they understand. So again, someone in Memphis, someone in Houston, someone in California. California's having a hard time right now. Just different geographies, to have those partners that really understand those areas. It's important too. It's very important.
So we're in in the last couple of weeks, there've been a lot of talk, especially from me, about refinancing. So for now, for these investors, is refinancing still a good option when it comes to LLC financing? Like,
Yes.
how is it? Because most deals on the investment side are 5-year fixed rates, correct?
5 year. Well, you have some deals that are structured with a 5 year interest only
Uh-huh.
component. You also have deals that are fixed on a 30-year basis with that 5 year IO, meaning 5 year interest only component in place. So you might write paper. I might write a loan at 6.5%. It's a 30-year loan, but for the first 5 years, you're only paying the interest on the loan. No principal.
And it'll be a 30-year fix.
Yes, it'd be a 30-year fixed.
So with someone who has that type of loan right now, you think it's advantageous for them to look at refinancing and trying to save money? Is there opportunity? Well, I guess the question I'm asking you, with the interest rates the way they are right now, although they came down and then they ticked up this week, is there opportunity for investors to refinance their portfolios to try to gain more cash flow right
I would say that, again, 3 days ago, we'd be having I'd have a different answer for you, but I think that you're going to see interest rates rise a little bit on the investor side. So
now?
if
Okay.
people are into those 30-year loans at those numbers, then they kind of should stay where they're at.
What about the people who have a 5-year adjustable? What should they do? Because I know a ton of people who have 5 years because the 5-year will give you a little bit better price
Right,
or rate to the world.
right, right.
So should those folks start looking at possibly refinancing while there's still some liquidity in the market in the asset-based platform?
Yeah, I mean, look, I think that comes down again, and we're always, I think you and I are on the same page. It's always going to come down to the situation and the deal itself. If there's a need for liquidity, it's a good opportunity. Yes, it's there. Um, a 5-year arm, I mean, I mean, there are so many variables there, right? Like, what's it tied to in terms of, what index to create that adjustable rate, so I think it would really depend. And
Okay.
I would actually defer to you. How have arms performed over the past 20 years, uh, from a conventional standpoint? Have they been crazy all over the place? Like, I don't think so, right?
If you got an arm, let's just say early 2000s when I first came into business,
Mm-hmm.
and then you kept that, when I first came into business, I was selling arms, 7 years, 10-year arms, was very attractive in price.
Mm-hmm.
Obviously the 3-year fixes and the 5 were attractive too, but for the folks who wanted long term, the property for the long term, they opted for the 10 years.
Mm-hmm.
And when the market went down, like after the Great Recession, and they went into that adjustment period, their rates actually went down
Right,
because the market was down.
right,
So it actually, I know folks, that went as low as 1.5%, 2% on adjustable rate mortgages. But obviously now the market is going to start rising. So, over the last 12 months, I've been refinancing a lot of my guys out of those products and putting them into, fixed paper,
right,
because it's just more beneficial for them. But arms are not the devil to me. You just have to
right.
be sophisticated enough to understand the game and
Absolutely.
pay attention to it. It's not for the weak at heart, but it could benefit you if you have right timing. I should say. I'm not going to say if you really know what you're doing, because all of this stuff is all about timing.
It's all about timing.
And
Right.
you never know what's going to happen in the world. But I'm recommending right now for everyone that I'm writing loans for, go with the 30-year paper or the 20-year paper, or whatever the case may be, just so you can have more security.
I agree with you there, especially Matt, on your side of the business. I mean, if folks are able to qualify, I mean, rates are low. They are definitely low, and they're
Oh, hell
probably,
yeah. You
yeah. I mean,
can't, although rates ticked up in my world, I'm still telling people there's still the same rates that the rates that I'm selling today is basically what I was selling in February.
right, right,
Basically,
yeah.
like
Like,
it's
and
not
it's
the
a
end of the
great deal,
world.
right?
Yeah.
And it's a
But
great deal. We haven't seen these lows before, so I mean, it would be fantastic. I think it's a great move if somebody's in an arm and they're, kind of, and again, things being where they're at, and you can put them in something that makes a hell of a lot of sense. Yeah, absolutely. And if somebody's in an arm on an investment property, I would say it's really deal specific. What is that, arm tied to in terms of an index, whether that's, the Wall Street Journal Prime, is it LIBOR? And I don't want to get too complicated, but where's the pricing at? And if it makes
yeah,
sense, then lock in. If it doesn't, then don't.
then
You
don't.
know, yeah, yeah, really deal specific, and always looking at cash flow as well. Like, those are, as we know, those are the things that are important per deal.
So with the asset base for rental properties, right?
Hmm.
Um, for a refinance, you're going up to what LTV?
Well, I was doing. I was at I was at I was at 80% cash out, which was fantastic. Um, I think we're going to see a pullback to about. You're going to see people talking about 75%. I believe we're probably going to see a 10% pullback. 70%. Uh,
Mm,
75 if you're a good borrower. but if you're high, I'd say mid 600 to 700 score, you're going to be at like a 70 LTV deal. So it would be really beneficial for those people who are fixing, as opposed to fixing and flipping. Maybe they were fixing to rent, which is it's a different animal that we didn't touch on. But, there are those people that are buying properties, renovating them, and looking at the end numbers. They're looking at the ARV, has to make sense. And they're able to refinance out of that 65% ARV loan, with a 70% LTV loan, and have the property cash flow. So I hope I didn't lose anyone there, but
no, that was simple.
Okay. So yeah, I mean, but I think you're going to see that there's going to be some buoyancy, and this stuff is changing by the hour, Matt, literally by the hour.
So long story short, on all platforms, all products, I should say, from hard money to asset base, to all types of investment loans, expect correction with the guidelines like right now. And all investors need to adjust their way of thinking of how they're doing their business.
100%. Definitely. And for those in the tri-state area, they got to remember something as well. I don't know if we're going to have a shutdown, right? We don't know.
Mm-hmm.
But what's going to happen with recording? What happens with, recording mortgages and things of that nature?
Well, right now is no issues.
No issues right now. Right. And I'm hoping it stays that way.
I believe it will stay that way, because listen, if they're shutting everything else down, then where's the revenue coming for the city?
Right. We're at a screeching halt.
You know what I'm saying? So real estate is one of the biggest revenue monies in our city. So
absolutely.
And with banks, there's a lot of, we could e-sign and do a lot of different things.
Sure.
And that's kind of, changed over the last couple of years. Now, I don't know if all the cities and the courts have caught up to the technology and everything.
Right.
But I think they will. They still. I don't think they're going to shut it down. Like me personally, let's hope not, because
I hope not.
Let's hope not, because if that happens, then then that can lead to just bigger underlying issues in the world, and that can really send everything kind of tumbling down, in my opinion, because then that means banks will start imploding if they can't fund.
And nobody wants to see that.
Nobody. That's the worst thing that can happen. I tell people all the time, I'm not panicking until I see, an implode meter come up when they start showing banks going out of business.
Right.
Then once I see that, then I'll panic. But other than that, there's no need to panic.
There wasn't a financial crisis prior to the pandemic. I mean,
correct.
Let's look at things for what they were, prior to this happening.
Good.
Yeah, it was moving. There were no issues. So obviously this is a situational type of thing. Has it affected things? Absolutely. But we had a very healthy economy, and I'm bullish on the market as always. And we've gotten through worse, and we'll get through this. And at the end of the day, everything will be all right.
So with fix and flip, we already established that proceed with caution.
Yes.
Are you more bullish or bear on buying and holding right now?
I'm so bullish on buying and holding. I've always been. I like to call myself a collector. I buy a piece of real estate. It's like a painting. You just tuck it away. It hangs on the wall or whatever you do with it. You're not looking at it every moment and asking what the value is. You kind of know what it is. The beautiful part about the real estate, obviously, is that it throws off income. You always want to be looking at stuff like that. But yeah, I mean, buy and hold, I am 100% for. I'd rather see people buying and holding because it makes sense. You made a fantastic point. Cash flow over equity. I'd like to see, both pari passu, meaning both in line, and if you have some equity, fantastic. But at the end of the day, if things were to maneuver in a downward manner in terms of value, which I don't see happening, you still have the cash flow. People still need to pay rent. People need a place to live. So
absolutely,
that will not change.
No, I don't. That will never change.
Right. So I don't think you can ever go wrong.
All right.
being
So
income producing.
anybody on the Zoom call, if you're on the Zoom call with me right now, if you have any questions for Kevin, because we're coming up on time right now. I didn't realize we've been into this conversation for an hour. I can talk about this stuff all day.
I had no idea.
So I'm being a little bit selfish here. So I want to give anybody an opportunity that's on a Zoom call, or even if you're watching this on YouTube right now, I just put the link to the Zoom call in the comments. So if you want to join the Zoom call, or if you're on Zoom, if you have any questions for Kevin, if you're on Zoom, raise your hand and I'll call you on live so you can ask him your question. There was a couple people in the YouTube comments that were talking about deals and stuff like that. So I'm not going to sit here and read those comments. Sorry. So if you want to ask Kevin, because I think it'll be a better conversation if you just come on and just explain what you're trying to get accomplished, and then he can give you better advice that way versus me reading something. So the link is in the YouTube comment. Join the Zoom call if you have any questions. Anybody on Zoom, if you have any questions, please feel free, raise your hand. I'll bring you on right now. So while we're waiting on that, and I'll give it a few seconds, because if you guys don't ask questions, then I'm gonna just keep going, and we're gonna stop this because I got things to do and Kevin got things to do.
Yeah,
right?
absolutely.
You know, this market is too crazy for us to be spending all day on damn YouTube. So, damn, I lost my train of thought. So,
It's okay.
so with are there any creative, like, well, it's probably gonna be hard to ask that question right now for the sheer fact because we got this COVID-19 and everybody's kind of going crazy right now.
Right.
So I'm pretty sure all the creative things that you were able to do 2 weeks ago is kind of come to a halt right now, temporarily.
Creativity really comes down to deal structure, quite frankly, if you ask me, Matt. Maybe certain things, but there's, where there's a will, there's a way.
Okay.
And I pride myself on our ability to structure. So if we have a viable candidate, a good borrower, then, things can still be done. And obviously the situation needs to be right. So.
Okay, there we go. So we got Griffin. Griffin, I'm gonna unmute you right now. Can you hear me?
Yes, I can hear you.
All right, talk to me. How are you today?
I'm doing well. How are you doing today, Matt?
I'm alive and blessed. I can't complain.
Fantastic. And thank you, Kevin, for being here today and sharing all this knowledge with us.
No, thank you for joining us.
So I have a quick question.
Sure.
It's about asset-based loans. So, and you guys talked a little bit earlier about investing out of state. So say you're investing out of state and the building, it costs what, $50,000, but the renovation on the building is going to cost you $100,000.
Okay.
How does that work? Lending.
So you have 50,000. Okay. My question to you is how many units are we talking about here? Just
4 units.
4 units. My next question would be, what's the after repair value?
In the area, normally the buildings are going for about like 130, 140.
So you're buying a building for $100,000, correct? That's what you stated?
The building itself costs 40, but it's a complete
40.
gut job.
I'm sorry. Okay.
But it's like a complete gut job. It's going to take at least 80 to 100 to fix the entire building.
Gotcha. So $40,000 purchase, $80,000 renovation budget. That brings us to $120,000 gross number, correct?
Mm-hmm.
Okay. You're saying that the buildings in the area go for $150,000?
Yeah, around that area.
I mean, you would have to come out of pocket on a deal like that. If you did the basic math on that, you would be 3/5. So, I mean, there's definitely, what would the income be on the 4 units? That would be another question once it's completed.
There's also a basement that's unfinished, and I was thinking about renting the basement as well as a unit. So in the area, rents range from $1,300 to $800. So
Gotcha.
figured if I can rent all 4 of those units out for about $795, $800 each.
Okay. To me, that's a good deal. And I would say that because even if you're at $150,000 upon completion, and you have to spend 120, your cash flow at the end of the day, it's great. I mean, you're at an 80%. Your profit margin is 20% if you were looking to sell it. So that's a little tight. But if this was something where you were fixing to own and keep, I think it's a great deal. It's fantastic.
It's a buy and hold.
It's a buy and hold, and it's a great deal. I think it's a great deal.
All right. Well, thank you.
No, thank you. I appreciate the question.
Thanks, Matt. Thanks, Kevin.
No problem. Thank you. All right. Does anyone else have any questions before we wrap this up? Because this was that was a good question also.
That was a great question.
Yeah, deal flow, deal structure, YouTube. This is your final chance to get on. If you're in the Zoom call, this is your final call for questions. Like they say, final call for alcohol. This is your final call for questions.
3:50 p.m. a.m. Excuse me.
Seriously, before we wrap it, well, the COVID is like 6 p.m. now. So,
oh man.
So look, closing notes, because it looks like everybody's quiet. Oh, we got Billy J came at the last minute. Billy J,
all right.
Talk to us, Billy J.
Hey, what's going on, guys?
Good.
What's up, Billy?
All right, quick question. We have a second property that we own for probably about 20 years now.
Okay.
And we're on the low end. We only owe about $6,000 in our mortgage. And right now the property value in that area right now for a 3-1 is about $225 to about $240. If we added another bathroom, it jumps to about $235 to about $260 in that range or whatnot.
Okay.
Because we only owe $6,000, I wanted to kind of refinance, but we were trying to keep another home with our primary home or whatnot about 3 years ago, and my mother filed the Chapter 13.
Okay.
So, and it's still active up until May, but obviously all of this that's going on is probably going to be a little bit extended.
A little bit longer, right?
What would you recommend to do with that? Should we fix it up and sell it, like I said, in a market that it can go for around those ranges, or can we refinance with I guess a cosigner or however that would work?
So when you say 3/1, what explain that?
A three bedroom, 1 bath.
3-bedroom. This is a single family home. It's
Yeah,
an
single
SFR.
family home. Yeah.
What would the income be on this property? What's the income?
Right now we're renting out at $1,000, but it's for a friend. But the market for a 3-bedroom, 1 bath is about $1,400.
Okay.
And for a 3-bedroom, 2 bath, you can basically add about another $150 on that, so about $15.
And what would it cost you to do that additional bathroom?
We got a bid for, I think he was charging $6,000.
Okay. $6,000 for 1,200. Because if you look at it, if you're only talking about $100 increase for that bathroom for the month, then you're talking about $1,200. It's going to take you 5 years to recoup that $6,000. So don't necessarily know if that's a necessity. What I would recommend is the property held in her name.
Yeah.
Okay. So if there's a need for cash, okay, and you can keep this and let it cash flow. I'm always a believer in keeping assets. I mean, why not? Why just sell it for cash, and when you can keep it, let it cash flow and let it appreciate over time, like you guys have been doing, right?
Of course.
So let's say again, your gross income is $1,400. I would say that your expenses should not exceed, $980 to $1,000 a month. And you would be able to make something work. 100%, you would be able to get cash in hand. The property would have to be in an LLC. So how I would structure a transaction like that is obviously maybe assigning the property to an LLC, or putting the property into an LLC, not assigning. I know that there's a $6,000 mortgage that's there. Who holds the debt?
You saying the bank?
Yes, I'm sorry. Yeah,
Chase.
the bank. Chase. Okay. Regardless, you're able to put this into an LLC. What I would do is I would have, yes, a co-borrower. Once that LLC is created, there would be a structure that would primarily put another guarantor, signer within the LLC that would guarantee the loan, and you got a deal. I make it sound very simple, but it's really not complicated. And I know, that's how I would structure the deal. I would basically have another individual come into the deal who has the wherewithal, credit wise, etc. And mom would become a minority owner per se, whether that's for the time being or,
and she's trying to clear out. So she's getting in the senior ages. So she's trying to clear out everything.
So then it might be beneficial. How many siblings do you have?
No, just me.
Just you? I mean, look, we know what happens with things as people get older with healthcare, like costs. And I didn't even ask, where are you from?
Miami.
You're from Miami. So I'm not really too familiar with Miami, but in New York, man, they bang you out once an individual's over 65, and there's Medicare and Medicaid and all this other stuff that's taken into account. So that's the last thing you want. So it might make sense to have her maneuver the property into an LLC, have somebody have more ownership. And then I don't want to get too complicated, but I can, and, maybe put the property, the LLC, into a trust.
That's it.
Yeah, just to kind of shield things. And because again, a trust, is some people know, some people don't. It's not the trust itself is not a recorded document. So it just outlines the conditions of whatever the forgive me, lost my train of thought there for a second, is. So and it basically shields who the owners are, which is important. Liability. It's very important.
I get you. Appreciate it, guys. Thank you.
Absolutely.
I like this, man. That was a good question, Billy. Good scenario.
Thank you, Bill.
Thank you.
All right, guys. So look, that's all we got, man. We're running on an hour and a half right now. Kevin, tell us how, if anyone wants to reach out to you, if they want to do business with you, get funding for their projects, how can they find you?
They can find me on Instagram at, how do I say this? At MR, Mr. Stands for Mr. Kevin Orlando, my name. So at Mr. Kevin Orlando, that's Instagram, IG. And if anyone has a scenario that they'd like to present to the firm, loans, LOANS, at Go, GO, Realty, REALTY, CAP.com. And someone usually gets back with an inquiry within 12 to 18 hours, I would say.
Okay, there you guys have it, man. Hit up my guy Kevin. He's the go-to for a lot of people that you guys see on social media. I'm not going to name no names. That's not my place.
Mine either.
He's the go-to. If you just peruse around my page, you'll see him posted a lot. Look, he knows his stuff. He 16, 17 years of experience. He had a record-breaking day of 75 million in one day, Kevin.
Yeah, that was a good day. It's a good day.
He's a killer. You know what I'm saying? When it comes to real estate financing for investors, MG certified and referred to you guys. Use him. He knows his stuff. Anytime I have issues or problems or whatever the case may be, I want to run things by him. He's always a resource for me as well. So make sure you guys reach out to him with all your deal structure, your deal flow, and that way he can get you funding. Don't panic in this crazy time. This is when investors make a killing. Be smart about whatever deals that you're going to do next, especially if you're looking at the fix and flip. Well, even rentals too. Be careful, especially when what they talk about freezing evictions and all this other good stuff. Tenants will try to get over. Just be careful out there. Be smart, and everybody, stay corona free. Stay corona free here. You know what I'm saying?
I love it, man.
Keep the Lysol with you. Keep the wipes.
You got the Clorox wipes. All right. Yes.
Keep yourself sanitized and be safe. Kevin, man, I really appreciate your time today. I know you're a busy guy, so I'm not going to hold you up any longer. You guys DM him, email him, and let's get those deals, man. Do not stop buying real estate. This is when you actually need to buy more real estate and be very smart on how you buying these deals.
Let's go. Absolutely. Man, I'm humbled and grateful. Thank you so much. I appreciate
No doubt,
you.
brother. I appreciate you. Everyone, I appreciate you on YouTube. If you're watching this, please, I need you guys to like this video right now. Share it with someone who's looking to invest and wants to learn about finance. And again, my goal is to become the #1 channel on YouTube for everything real estate and real estate financing related. All right. So I need y'all support with helping me become #1. Make sure you like, comment, share, subscribe, and hit the bell for notifications. And you never know, I may come back on a little bit later. All right. So Kevin, again, I appreciate your time. Everyone else,
Thank you, man. Likewise, brother. Be
peace
well.
out.
You
Be
got it.
well.